Okay.
All right. Good morning, everybody. Good morning to you, John Walkup, on this very hot Monday.
You haven't seen anything yet. It's supposed to get even hotter in the coming days. So aren't you supposed to be in the city, Noah, this week?
I got to be in the city this week. One Wall Street presenting. The agency is running. We got Jonathan Miller there. We got the president of the agency there. We got Maurizio coming there. It's going to be Matthew Gerdner, chief economist, is going to be there. It's going to be a really good one. It's going to be 128 degrees, Johnny.
In the shade. Yeah.
It's going to be hot. So it'll be interesting. Hope to see you guys there. But let's just get this going, guys. It is Monday, so you're going to get a little macro Monday coming right at you. That is John Walkup. I am Noah Rosenblatt. We're both with UrbanDigs. And what we're going to do is we're going to start out with Manhattan real estate, go over a couple things over here, and then we'll go into a couple of macro topics up here. We're not going to go too heavy today because it's hot out. And then we're going to circle back. We'll circle back to Manhattan real estate and take a look at those rents, John. Take a look at those rents, the latest data on the rental market, post-Fair Act. And yeah, I know.
Speaking of hot.
Yes, seriously. And we'll try to do all of this in 30 minutes or less. If you guys got any questions, please, there's a comment stream right over there. John, you're going to keep eyes on.
Oh, yeah. Let me actually do that. Let's see here.
Eyes on the comment stream.
Ready to go.
In case you guys have any questions. And what else am I forgetting here? Oh, don't start trading this stuff, guys. None of this stuff is financial advice. You do not want to start day trading from what John Walkup says in terms of financial advice, okay?
That would be a bad idea.
All right, let's get going, guys. I was just messing around. I wanted to give a few minutes for people to get in here. We're scrolling down the dashboard here. So we're just scrolling down right here. Market Snapshot, Manhattan, 1 month. We do this every Monday to start us out. Let's take a look at the 30-day supply. We're at 1356. That is supposed to end the month at 1386. So we're already below. We're already below our monthly average. That might kick up a little bit here and there, but Johnny, I think that June is going to probably be the first month in like the last 3 or 4 months where we have less stuff coming on the market than typical season. It's been more stuff in the last few months, Johnny.
It has, and we've seen that weekly number kind of come off. I mean, look, we've entered summer, and that drop off has been pretty quick. So, look, last week was a holiday week, so you can expect, when we do the numbers, it's going to look a little quieter. Probably this week it's going to be even quieter because the closer you get or the deeper you get into summer, I mean, listings just don't start coming on. So yeah.
And this is the chart that shows that. I wanted to show you guys how I know this information. We track this kind of stuff, monthly new supply. The orange is your average. That's where you're supposed to be. The blue is where it's coming in at. So I can see 1, 2, 3. So we've been high. And it looks like that blue is going to come right back down. It's going to cross and do one of those looks like so far. So we'll keep an eye on that. John. Contract activity. It's coming in light, John, under 900. It's supposed to be at 1,055 for June.
Yeah, we had a strong week a couple of weeks ago. Last week was a little light. So it's looking like the summer's here, and it's looking like that volume is going to sort of hold in place at this lower level. So as much as I was hoping for sort of a busier summer, I'm not quite sure if that's going to happen. Look, I mean, listing volumes coming in light suggests that sellers and potential buyers, who those are, some of them might not be interested in doing it this summer. And, even on Brooklyn, like the Brooklyn market is kind of going sideways. So maybe if there's any hope, I might say it's in Brooklyn right now, but it's starting to look like summer.
Yeah.
It's almost like, what's that song? It's beginning to look a lot like summer.
Yeah, but I don't. Yes, no, but yes. And you know what? I take a look at contract activity in that same kind of chart, and it's kind of been underwhelming. I mean, we had a decent March, even March, as good as March was, right? Didn't it feel like March was really good? Like we were rocking and rolling. Even March was under the average.
Well, that's the thing. So we've been so down for so long that even getting close to the average felt like, all right, Manhattan's getting its mojo back. And then, well, it didn't.
Yeah. So let's go take a look at the market pulse. I want to stay on these charts just a little bit, guys, and kind of show you where I see the leverage situation. We're at a 5-year chart right over here. You can kind of see it, right? You can see it. That was our March, early April peak. We've shifted to this new lower level, and we've been kind of camping out here for a while. I like to look at this as the neutral zone, right? If sellers market's up there, if buyers market's down there, right? The last time we were in a buyer's market was, in the pandemic. We're somewhere in the middle. We're somewhere in the middle right now, but we're on the buyer side, right? That's the buy side of the neutral zone. That's the sell side of the neutral zone. So I think buyers have more leverage right now. I think it's not a good close for sellers. It's a little tough.
Yeah. Well, look, I mean, it's been a very topsy. I mean, you think about that 5-year chart, right? We've seen some crazy lows. We've seen some crazy highs. We saw lows again. So honestly, I think at this point, the market doesn't even know what normal is. It's going to take a period of time where stuff just sort of transacts. It's like, oh, okay, that's normal. And I still think we're just constantly reacting to the market that came before, which was just everything's been so erratic. We haven't just had a nice period of calmness to say like, okay, back in seasonal mode, getting close here, a little above here, getting close there, a little below there. It's just been way above, way below. It's hard. It's a tough market.
It's hard. And this chart, guys, which shows you the temperature of the listing climate, I use it all the time. Guys, if you don't use this chart, get good at this chart. It will help you get decisions, I promise. Sellers need to see that it's getting tougher out there, and that's what this chart shows. The last good spring season we had was back in 2022. As these bars go up, okay, guys, you see this little green line right here? See that green line? That's the easy listing market threshold. See that blue line right over there? That's the challenging listing market threshold. So as these bars go up, it's an easier listing environment. Sellers can get away with overpricing a little bit, still get activity. Here's our spring in 2023 underperforming. Here's our spring in 2024 underperforming. And here's showing that we had a good March, but then April and May just declined. So this resonates with liquidity, market pulse, listing climate index. They're all saying the exact same thing, is that this sales market has gotten tougher for sellers, a little bit easier for buyers over the last couple of months. Okay, so hopefully you could use this to make decisions. Yeah,
and you can see, right, the January to February to March, those were rising in climate index. That's sort of why these months felt better, right? There's more of that buyer energy in the market, and they're fading from March to April to May. And again, this shows up in the data, right? That sort of the steam going out of the market, leaving the balloon, so to speak.
Yeah, it is what it is. All right, so now we go into our slowest summer months. We got to wait till Labor Day, act accordingly, and hopefully your clients make their moves. We're going to shift. Any questions before we shift? Questions, comments, concerns?
Oh, I'm looking. I don't see any. Okay. But we are a little bit delayed, so if one comes in, I might just interrupt you. What do you think about that?
That sounds okay. You can interrupt me whenever you want. Let's just shift. Let's do a little pivot, and let's go to credit spreads, guys. This is the macro portion of the program. Credit spreads are our canary in the coal mine for the general risk that's out there in the world today. It seems like it should be a lot higher with what's going on and the news over the weekend. But as far as I know right now this is going to look at bond market activity. Right now it's looking at Friday's close. So today's bond market activity, right? It's not done yet, right? Today's bond market activity reflects here tomorrow at 10:30. Right, so you guys can come here and check this. What you need to know, let me click the max button. Okay. What you need to know about credit spreads is, let me get rid of that. As credit spreads rise or widen, okay, credit stress in the system is rising, and stocks are probably going to enter a risk-off period. If stocks enter risk-off, stocks are selling. If stocks are selling, confidence goes down. People go, well, we saw it, right? We saw it in April. We saw what happened. That's why we watch this kind of thing. And this chart showing the great financial crisis and showing the pandemic, I think, puts where we are now into perspective. And when we take a look at the 1-year chart, that was the whole thing. That whole widening right there was the thing. It never really materialized, and credit spreads are coming down. Risk on. John?
Yeah, I mean, my thoughts on this. I tend to think that this index is going to go up rather than down. I think we're sort of at this point where we sort of normalize, if that can be used after everything that we've seen with Liberation Day, all that stuff. I guess I don't want to put any kind of positive or negative spin on it, but the events over the weekend are not necessarily translating to the market, right? The S&P is up today, bond yields are down. It's as if that whole thing is completely localized, regionalized, and it's not necessarily, coming to the forefront of investors' attention at the moment. So again, I think when I look at credit spread alert here and I think about the direction of these things, to me, it seems like the bias in my mind is up, because I feel like if anything does happen, it's more likely that it's going to push this up rather than push this down at this point. So I'm cautiously optimistic, but I maintain my caution.
And I respectfully disagree. I think I disagreed with you last week and the week before that too. I think we have a general disagreement. I don't know if the bias of this is up. I don't know. I mean, I feel like this is just not going anywhere. It's drifting lower. You said something really, really, really important, John. The markets are not reacting like you think they might have after what happened over this last weekend, which makes me wonder, are the markets sniffing out that this is just, it's not going the wrong way. It just might fade or something. It might pass and it's not going to be a major event. I know, of course, it sounds like a major event. It is a major event, but the markets are just not reacting like you would think they would. So
yeah, well, I think it's one of these. Well, I think it's one of these. Look, that's a different sort of actor. I think the idea is that there are known knowns and there are unknown unknowns, and I think we're approaching a set of unknown unknowns, which to me argues for riskier markets and credit spreads rising. So that
sentiment is why I think this rally goes up. I think this is, like I said this. I think it's the most hated rally ever. Right. Ever since the whole tariffs thing, I'm like, this is going to be if we come back and it's going to rip. Most hated rally ever. No one's believing it. And the shorts, those people that are betting against it, ultimately, if it doesn't come to fruition, they have to cover their shorts. They got to buy. So that's added buyer pressure. So I don't know, man. I wonder if we're going to rip even a little higher because no one's expecting it. The pain trade is up.
So I wouldn't. I don't argue against that. I'm simply saying that I think there's a whole ocean of risks out there right now that are not well understood or even conceived of yet. So I'm a little bit wary of that. But I mean, look at the underlying economic data. I mean, this country's doing pretty well, so to speak. I mean, there's been a lot of stuff thrown at it, and it's persevered and it's handling it, I think, very well so far. So this is why I say I'm cautiously optimistic, but I maintain my caution.
Well, you know what though? We're at a stage 2 moderate level. We're not down at stage 1 at low stage 1 level. So the fact that we're still elevated, we're not down to these low levels, I think warrants a little bit of caution. So that's noted, and I definitely respect that. All right, assuming no questions, let's go to Fed. No questions, Johnny?
Don't see
no questions today. Come on, guys. It's hot out there. I know, but we need some questions. You guys don't want to hear us talk all the time. We need to hear what you guys think.
I certainly don't.
John, keep our private conversations out of the live stream, please. We're live.
Game face. Yes.
Game face. All right, guys, let's go to the Fed. Every week we do this. We are at the CME Fed Watch tool. Okay. Fed Fund Futures. That's what this is. Probabilities table. You guys could do this yourself. It updates every day as well. What you need to know. Tell me what you need to know. We are at this level. We had a Fed meeting last week. As expected, no change. You guys knew that because you come to this show and see this table. So let's tell you what you need to know. The next meeting is July 30th, 77% chance. Pause. It's in the exact same category. September meeting, that's still a cut. It's rising. Have you noticed that, John? It keeps going up.
Yeah.
That cut. 64%. I think it was like 59% last week.
I know. And silly me keeps wondering why there's not a column on the right side. So I'm going to stop wondering why there's not a column on the right side. I'm just going to lean into the idea that there might be a cut in September.
Oh, over here? You mean? Like there's nothing down here?
Yeah. Why is it not like 0.01%? Why is no one thinking?
It is weird. But the first cut, quarter point, that's a quarter point right there, guys. Don't be scared by basis points. Okay, just put a little dot. Look, 4%. 4.25%, 4.25%, 4.5%. That's all that means. Wall Street likes to be different and act a little sophisticated and say basis points. 25 basis points is 1 quarter point. Okay. So September 17th, it looks like you got your first cut. October 29th, looks like you got your second cut. But the second cut is not as high as a percentage as the first cut. And there's a 37% chance we don't do anything in October. So we don't know. But the markets are thinking the second cut. But I don't know. I'm telling you, I don't know. Okay. Okay.
I mean, to me, this just looks like the Fed is going straight ahead. I'm skeptical of that cut in September. That's still a ways away. So I have to see what the data comes in, right? Inflation data, unemployment data. There's a lot of stuff can happen between now and September to influence that.
The Fed meeting last week they had the updated dot plot. Remember, we used to use the dot plot back in the day, and they had the statement, right? And basically, the takeaway was like very stagflationary, very, very stagflationary. Yeah. They expect persistent inflation. They expect slower growth. But also the general change of the Fed chairs were less cuts in general, So like, again, we don't know how many cuts there's going to be. So, all right, 1 in September, 1 in October, quarter point, pause in December. That's a pause. You're in the same category. There is another cut in January, guys, but we're starting to get in low percentages. Like there's another cut in June. There's another cut next September 2026. Jesus Christ, guys. Do not predict anything over a year out. Like your reputation is way too fragile, right? To put at risk putting a prediction out for what's going to happen next September. Nobody knows anything of what's going to happen. So the way I like to look at this, guys, is you look at the first couple of months, maybe like up to here or so. You know, it used to be up to here, first couple of months. And once this percentages goes below 50% and then below 40%, you use caution. Okay. What you need to know, 2 cuts, September, October. September looks like it's going to happen. October, not so sure yet. That's it.
This does look. I like to think about how this is going to affect mortgage rates, and I know it's not a 1-to-1.
Oh, I didn't take up the mortgage rate chart. Let's go get it.
Yeah, come on, no, I mean really.
I blew
you
it.
got one. You got one job, my friend.
I know. What is it?
Optimal but it's like when you, optimal blue.
Okay,
there we go. Yeah, you can bring that up. So what I like to see here when I look at the see if Noah can get this chart going. I like to obviously look at the difference between the jumbo, which is I think the light blue, and then the 30-year fixed, which is the dark blue. And typically when you see that conversion, that kind of suggests you might get a little bit of pressure downward in mortgage rates. Starting to see a little bit of it. And when I see the idea that there might be a Fed cut in September, that could argument for a little bit of down push. But I think you just drew a channel. I think we're in this channel. So we might get below it a little bit in general on the jumbo, but it seems to me that everything that's happening in the world, everything that's happening on the Fed's dot plot at the Fed Fund Future chart suggests that mortgage rates are going sideways for the near medium term.
Yeah, and that's last week's channel. I actually didn't draw that. Just came up from last week. But yeah, I wonder we're at the bottom of the channel. So technically you might see some support and then go back up here a little bit. So we're at the low end of the channel in rates. I wonder if it's going to break down to a new lower channel. But I don't know. You're right. It looks sideways right now for the last few months. Lower end right now. Okay, so that's that. 2 cuts. That's what you guys need to know. September and October. Okay, we'll leave that there. No final questions, Johnny?
Nope. Good to go.
All right, guys. Let's just show you a couple of macro charts. I mean, it is Macro Monday after all. And again, if you guys want us to talk about a topic, you just type it in that little live stream over there, comments, and we'll talk about it. What I see here in housing permits is they're going down. You know, multifamily has been down. Single family homes is going down. But everywhere I see builder permits, we always think like permits is leading indicator, right? Permits. Is the building industry increasing their building? No, they're not. They're actually decelerating their permits. So I don't know, something to keep in the back of your head.
Well, it makes sense given some of the supply and demand dynamics we've seen in some of the southern markets, right? Where supply is rising, demand is stagnant, if not decaying. So it doesn't necessarily make sense to build into those, especially if that's where your market, your building market is. So I can understand that. I'll tell you this: I would love more supply to come online in Manhattan and Brooklyn, like new dev. That we could use that. There seems to be a bit of a shortage of quality supply across these boroughs.
We got to get the permits for New York City. I think they're way down.
Speaking of which, we've got a mayoral primary coming up. Goodness sakes, is that tomorrow already? Wow. I mean, a lot of people voted early. I see the stickers. So if you have, thank you. If you haven't, very important day. We have ranked choice voting now. It's going to be really interesting to, go in there and rank who you want to go see. But look, that could be a big influence on the way this market goes. So again, right. That's another uncertainty in the whole NYC real estate mix.
You mentioned falling prices. Decent. Oh, we have a comment.
Comment, yes. Aside from general trends, do you see any asset specific? Oh my gosh, I can click it.
Click it.
Here we go. I'm gonna click it.
Come on, amateur hour over here.
Aside from general trends, do you see any asset specific trends like in luxury or in under 400,000? Imagine more in the latter related to rent increases that we'll talk about in the next section. Yes. So I don't think I see any asset specific trends. I mean, look, luxury's kind of been doing its own thing, but I think seasonality is really the weight on everything's shoulders right now. So I would expect the differences between those trends to be muted as we get into deep summer.
That was for Manhattan? That question?
In general, I suppose.
Okay. This is the deceleration in home prices year over year in pictures, guys. There's like 4 or 5 different measures of home price. This is national. It's not Manhattan. Manhattan home prices actually are rising a little bit, reflecting March's strength, but that is probably going to be short-lived and it's probably going to come back down. But this is basically showing what's going on national. You know, when you get everything together national, it tends to like kind of balance itself out a little bit. But, you know, you guys need to know is that there's a downturn going on in this housing market. It's really very, very different. Look at New York, all the way in the left, right over there. It actually has us up 4%, New York. That's, of course, probably New York, I don't know, county. I don't know what they consider New York. I don't think it's just Manhattan. But it is a very bifurcated market out there. And a lot of housing markets are actually going through some pain right now. There's some markets that are down 15, 20% from a couple of years ago. It's a very, very, very different situation, John.
Yes. I don't have much to add to that, except that.
Good answer.
I generally don't like looking at national housing trends or these because it's just, that's the one thing about real estate that makes it to me very, very interesting is that every home is a unique proposition. So, you know, looking at a national trend to get a sense of where any home or asset might trade is sort of, you don't get a lot of signal there. It's just a lot of noise. So I'm interested to kind of see the macro waves, but I really just give it a grain of salt.
Very, very, very local, very local, very, very local. And we're New York City, right? So, I mean, do we even care about national housing market? I don't know. This is a macro show. That's why we put it up there. Just like with home builders, Lennar. I mean, I don't think we have any Lennar buildings in Manhattan. But guys, this is what's going on outside of our little bubble. I just want you guys to be aware of what's going on out here. It's very, very possible that we are going to overperform this housing cycle relative to a lot of other markets. I know it doesn't feel like that, but it looks that way. Lennar's average selling price net of incentives in the second quarter is dropped 24% down from a couple of years ago, down 8.7% year over year. So again, it's something that is actually happening out there. Right? Interesting.
Yeah.
Okay. And finally, guys, we have made it to the end over here. I think this is gonna be a short Macro Monday, I guess. But the FAIR Act, this is what everyone's talking about. And John, why don't you tell us? Everyone's asking you to look at the rental data. You did, and you're looking at it every single day. And where are we at? 5,300 since the FAIR Act?
Yeah, I think if you go through listings as of June 20th, we're on, I think the median for the new listings is like 53 something. So it's up about 12 or so percent from pre-FAIR Act. And you can see basically what I did is I looked at the median listing price each day as they came into the market. And you can see that each day, generally speaking, it's higher than what came before. And the median of all those on average is the median of all of them is higher than the previous median. So there's definitely something there. At the same time, the volume of listings has gone down. So it's
way down.
This rental market is really, really tight. And just to get back to the other earlier questions about, are we going to see any of this translate into the sales market? That's a great question. And I look, it's way, way too early to tell. It's even too early to tell if these rent increases are going to stick, because, a lot of it is the fact that this is happening at the peak time in the rental market. So it's going to take a little while to separate the wheat from the chaff. Is it the FAIR Act that's pushing up rents? Is it the supply and demand dynamics? Either way, I do think it's going to be interesting in the sales market, especially in those units that are going to be hit the hardest, where you might see some of those biggest bumps. And I'm not concerned necessarily about the luxury market, because I think if you're in that price point, you have a little bit more flexibility in how you're going to operate. But if you're in the studio one-bed market and you're more financially constrained, the sales market might start seeming like a better use for your time and money, especially if you're going to be in the city for more than a few years.
I don't know. It's too soon. Noam Newman, remember Noam Newman? He said you got 1 or 2 years of this before it starts making much more sense. And then you got the flip. It's like happening so soon afterwards. But you know what? I'll tell you this: what this is doing for the sales market, it's creating an artificial bottom of some sorts. It's imagine any seller that has the capability of renting. At least they get to tap the rental market as an alternative and wait a year and bring it back. Right? We've said this for a couple of years. I mean, over the last decade, sales has done nothing. Like, what has the rental market done? The rental market has just been by far the outperformer out of both these markets. And it just looks like it's going to continue to me. I mean, what do you guys think? I'd love to hear comments from what you guys think. Is this an immediate reaction, what we're seeing right here? Is this not going to last? This 5,300? Is it going to go back down to 4,750 where we were before, or is this going to go up to 5,800?
I have thoughts, and I'll share because I can. My sense, Noah, is that I think and I don't know what that level is, but I think there is a level at which point the median rent this is RLS data, so it's naturally higher than what you're going to find on Street Easy, all these places, but right. these are legit listings. So when I look at that, I think that there's definitely a level at which the rental market becomes uninteresting. I don't know what that level is, but I can tell you that you can see it when you look at the supply and demand numbers. So I don't know if you remember the post-pandemic, right? When you start to look at how many units were rented out versus how many were available, late 2020 going into early 2021, the market was totally upside down. And the incentives that landlords were throwing at tenants to either renew their lease or move in or stay was bonkers. That market flipped and then it started going parabolic. And that's when you started seeing 30% year over year rent increases, all that kind of stuff. And we really haven't looked back. We're not doing the 30% anymore, but it's just steadily marching higher. At the same time, what has the sales market done? It's basically gone sideways. So this is why I'm wondering if we're going to see, like, and some people I just can't anymore with the studio market or the one bed market, $5,000 or $6,000 for a studio one bed. Like, all right, maybe it's time to think about what I could buy for that. So.
Yeah. And you're right. It's interesting. It's happening faster than what Noam was saying. He said it's going to take a year and a half. Is it happening soon already? Here's the sales market, guys. Here's that sideways action. You can see the data I was telling you about. This data that's coming in right here is reflecting the strength we had earlier this year. It's not really reflecting now, right? It's not. If you signed a deal yesterday, we're not going to get that for 3-4 months. So if you're wondering where price action is right now, today, we got to wait till September, October for that information. That's the lag. We see it in the other charts, right? Liquidity, pulse, climate index, all of it shows the shift down. We just got to wait. But for now, I'm seeing record prices coming in the sales market, which is just it doesn't fit with what's going on.
These are probably for deals negotiated in March, right? Yep. When the climate was rising, the pulse was at its top. It's like that environment argued for higher prices. It argued for a little bit of competition among buyers, which tends to rise prices. And we sort of edged away from that environment. So I'd be curious to see what the following months look like.
When's Q2 come out?
Yeah.
Q2 is.
Pardon?
All right. When's Q2 coming out?
Well, July 1st is the start of
July
Q3.
1st. Okay. There you go. So I imagine Q2 is going to show some strength, by the way. We have any questions, you said?
Plenty of stuff. Lots of conversation about the rent and the rental
market
in the chat. So we got a lot of stuff. I'll just read. I'm just going to read.
Could you click it?
So Karen, I can click it. I'll click it.
Click it. So people can see.
By the way, I just want to say thank you to everybody for writing in the chats. It's a lot of fun to click stuff and show it up here. So I encourage it. I hope we do it more often. What are other agents seeing in different markets for rentals? I've heard that people on both ends are pushing back. Some building and areas rents appear down, so the median is not telling the story.
Oh, that's quite interesting.
Possible.
Maybe.
Yeah. I mean, look, we have, like I said, we have RLS. These are typically higher.
Yeah, no open listings.
I would say it's not open listings. It's not, random stuff, straight to Street Easy from a landlord kind of thing. So typically that does argue for a higher price point in the listings. However, it's the trend that I'm more interested in, less so than the actual number. I'm more interested in what is those median numbers telling us, and that does tell us that there is a rising trend. I wouldn't be surprised if some areas and price points are maybe down. I mean, that's sort of the nature of the market, but I would be really curious to understand. And someone else asks this, why is the listing volume so down after the Fair Act? So I'd be very curious to hear.
You mean
from
the rental listing, Bob?
Yeah.
I feel like a lot of rental listings just came off the market.
They did. So I'm just curious, like if you're dealing with landlords, if you're dealing with renters themselves, what that on the ground, boots on the ground reaction is to the new environment post Fair Act.
Yeah, I mean, there's a lot of confusion out there. There's a lot of people just pausing and stalling and trying to figure out how it affects their business, all that kind of stuff. I mean, I wonder, I mean, does it make a cleaner marketplace? Does it make I mean, the landlord pays their rent now, right? I mean, the landlord's not going to start showing apartments. I don't think. They're not going to deal with that.
Well,
so
I suppose the way I think about it is there's definitely a cost to getting an apartment rented. And is the landlord going to pay that cost? No. All the costs are going to be paid by the consumer. The question is, do you pay it up front or do you pay it through the life of the lease? So one way or the other, generally speaking, the consumer bears the brunt of the cost. It's the same as tariffs, right? You can add a tariff, but in the end of the day, it's the consumer that pays it. So
there you go.
That's my
there you go. Interesting. I'm going to let the rental experts talk it out over there. I just don't know that market that well. So again, I wonder if this is an immediate reaction, or is this the start of a new trend, or is this going to go revert and regress back down to the pre level? That's what I'm more concerned about. So
yeah, I'm just going to post another comment here. This is a good one. For Midtown, Upper East Side, average rent increase has been about 3.5% on free market units. Also, all tenants have renewed and staying on board in Manhattan. Queens market also has high retention. So again, it's a very local, very specific market. So it's interesting to see that those numbers are a little bit lower than ours in terms of that delta. But I'm not surprised it's still positive.
Yeah, I feel like it's going to be a tight marketplace. I don't see the trend changing. I think the rental market continues to outperform the sales market, and I think the sales market is just going to tread water until the math starts mathing. Whenever that happens, it may take some time. Okay. Final questions? We're good.
No, all good. I have one more comment I'd like to put up here. I hope you guys don't mind me sharing your comments. I think this is really interesting stuff. Took a $2,500 a month rental listing off the market on June 10th. Came back Friday, no fee at $2,750. The landlord's paying me $3,000. Have 2 applications in, so that's great.
Yeah, that's the thing. I think it just might get cleaner. The landlord's just going to pay the broker. You don't have to worry about it getting it from the tenant anymore. I mean, yeah, the rents are going to go up, but I don't see the landlords just en masse start to showing apartments. I just don't see it.
Well, that's a 10% increase, right? So that's boom, boom, 2 applications. So
there you go. That's what I think it is. It's going to be more like that. Thank you for sharing. All right, guys. Well, listen, you know what? We're going to keep going over this every single Monday. We'll keep checking at all these critical things so you guys have a general idea of what's going on. You don't have to think about it. You guys can go out there and sell. Tomorrow, if you're around, we're going to go gather up a couple of quarter charts, end of quarter charts, so that you guys get the heads up on all those quarterly reports that are going to come out in the next week and a half.
Sneak peek.
Sneak peek kind of a thing. So you guys know the narrative and the talking points. All right. Thank you, John Walkup. I am Noah Rosenblatt. We're both with UrbanDigs. It's been Macro Monday, and we'll catch you next time. Cheers, everyone.